This is the rental market update for you, AVID investors, and I'm so pleased to present Melissa Sharone. She's joining us from First Rate Property Management today. And we've had Kat weigh in last month on rental market update, just gave a quick blurb on it. But you've been asking a lot of questions about the rental market and what's going on. Tom's not here, but he's been asking some questions. And so I'm going to record this rental market update so we can share it beyond those who are able to attend through Zoom. And I'm going to put this slide up for you, Melissa, because I know that vacancy is a significant thing right now.
Yes, thanks, Stacy. So what she's showing you here is basically data collected from the Southwest Idaho chapter of NARPM. We do a quarterly survey, and it's a plethora of a bunch of property managers, some single, some multifamily, larger companies, smaller companies. And it has in this first quarter, really since quarter 4 and carrying over, we are at an all-time record low since we've been doing this for 10 plus years. So vacancy remains very low. I will tell you, our data today, we run our vacancy every week and we are at 0.3. For May, which is another record since I've been at First Rate for 11 years. And we see that trend continuing. We are another important detail that I'll share for people investing in those multifamilies or really even rentals in general. Average days on market is taking a dramatic dip. We've gone from an average from about 15 to 16 in the last probably 2 or 3 years. We're down to 9 days. So what that's saying is that a property on average only sits for 9 days. Most of ours are going in 2 to 3 days. Deposit approved, rented, waiting for the other tenant to move out so we can get a new tenant in there. We are seeing a little bit higher renewal rates. Not that that's a bad thing, but you're getting those increased rents of anywhere, probably an average of 20% right now, which seems crazy to me. But a lot of it's due to COVID. A lot of owners chose not to renew based on not to increase based on the circumstances. And so we're playing catch up and tenants understand that. Our renewal rates, I know speaking from First Rate, are probably slightly under what you could re-rent a turned over property for. And that's a big education piece that we give our clients when we remind them, when you turn it over and upgrade and clean and give basically a brand new unit to somebody, you can get a little bit higher rent, but we're still seeing increases in the 20% on renewals. But more what that's causing is a little bit more. We're finding more renewals rather than somebody wanting to give their notice and move just to get to a new property. They know in this market, because of the prices, that they're still getting a good deal. I'm not going to complain about renewal rates. That keeps the return on investment for investors good, because there's not turnover cost and all that comes with that, advertising and all that stuff. So record lows across the board, inventory is low. Vacancies is low, rates are increasing dramatically, and we see that trend continuing at least through August, which is a hot month. And really before, we would say you want to get all your stuff filled August, September before the slow season. But because the demand is still so much higher than the supply, that I don't think we're going to have those vacancy issues even in the slower months.
Wow.
Anything else you want me to cover, Stace, or do you want me to just let people ask questions?
Yeah, if you don't mind talking about whether the multifamily rents, and guys, get your questions ready, but whether these multifamily rents do indeed look right on. This is NARPM data, so I know there's a slight delay to it. And it seems as though the rental market update has been experiencing increases sometimes faster than data can keep up as well.
Yeah, so this is Q1. I would say that our values are probably higher than this now. Based on what I can speak from my inventory. We manage 1,300 doors, so we have a big chunk out there. I would say your 1 bedrooms are probably closer to 1,050 would be the average. Your 2 bedrooms are probably closer to 1,250. And so up. Same with the 3 bedroom, even multifamily. It's definitely in probably the 1,300 range from there. We are seeing an influx, the increases in, or the amounts in Canyon County versus Ada. Some of that seems skewed. It's not. there's just so much more new build in those areas, and those brand new units are running, like a brand new 3-bedroom is running for more than an older bedroom, in Ada County, if that makes sense. So it seems like the trend's always been Ada County is a little bit more expensive than Canyon, but a lot of that is new build. And so it's relative. And that's where people want to be. They want a newer rental, but it's the same price. If you were to have a newer build in Ada County, it would definitely be higher than that $1,289. So
and we have seen a lot of that new build
right.
in Canyon, it seems like.
And then let me look single family. These are probably a little bit, your 3 bedrooms probably okay there. Your 4 and 5, you're getting, those are probably higher averages in this time of year. Last year, location and timing wasn't such a big deal with COVID because kids were home from school. As schools start to go back in, you're going to see that rush to get settled before school starts again. So that mid-August range, if you do have single family rentals, we highly recommend that you have them expire either before that season starts. So they're forced to really either stay there at that higher rate or make sure that nobody's leaving past July 31st so you can get that filled before school starts again.
And that's great advice. And so I think I heard you say those rents look spot on for the 3 bedrooms that you've been seeing in Ada and Canyon. But
yeah, for single families, those are pretty close, maybe a tad higher as we get into June.
Well, and also you've said before, as you get into brand new or super new rentals, then all those 3 and 4 bedroom numbers increase even further.
Yep. I mean, I have brand new 3 bedrooms that we rented in February for $1,900. $2,100, but they're brand new. So yeah,
and I love it that you guys are managing in all over, well, in both Ada and Canyon County in the Valley. That's been super helpful. And any questions for Melissa?
Yeah, Melissa, on the 3 and 4 bedroom single family rental rates, does the square footage size of the house really play much of a difference, or is it really just the bedroom count that people are looking at?
If you ask my opinion, I'm going to say a bedroom count's probably a little bit more important than the square footage. Sure. And that's because they're really geared towards families. Now, keep in mind, a small 9x9 bedroom is going to differ than a typical 10x12. Does that make sense? So, I mean, I think there's a lot of factors that go into it, but I think the bedroom factor is going to be a little bit more influential than that overall square footage. You're seeing a lot of houses with those like extra lofts at the top of the stairs, and that space is nice, but you're going to rent a 4 bedroom, 3,000 square foot house for more than you're going to rent a 3 bedrooms, 4,000 or 3,000 square foot house. Does that make sense? Yeah. So when you have comparables, if you have that added space, especially with people working at home and that trend continuing, you're going to see people that want a bedroom beyond the amount of children and or family members that they have.
Sure. Another quick question. Well, I guess, Stacy, are we going to get this slideshow after the slide deck after this meeting's over?
You can hit me up for it. I don't usually broadcast it, but I'm happy to share it. And
okay.
I'll also, yeah.
And Stacy, just so he knows, we post this on our blog. If you go to our website, which is frpmrentals.com, under blog, across the top, there's a blog section, and we post this whole report and a little synopsis of it, if that's what you're looking for.
Yeah, that'd be great. Thank you so much.
Yeah, that's a great blog. And Melissa, do you remember the sample size?
Of units or people or companies?
Units for the vacancy chart 2 slides back. I was just curious.
I can get that info for you. It's about 20 companies.
Okay.
And I know myself, Johnson Property Management, which is about 1,000 units, Home River, which is a big player. They're about 5,000-6,000 units.
Okay. Wow.
Those are the bigger players. And then you got some smaller people that have, anywhere from 200 to 600 units that put into that. So I can probably get the number from Cassie. I just don't have it because I don't run this.
Okay. I was just curious. It seemed to be jumping up and down quite a bit. No.
Yeah. And it's participation is key in this. And sometimes it's not hard. It's just a matter of who's filling this out and willing to do it.
Yeah.
Well, and also notice the time duration in terms of the jumps on this slide. We started at Q2 2017. And
Mhm.
so,
Sure. I'm just looking like Q2 19 to Q3 19, and it really bottoms down and then goes up
Yeah.
in 20, which I would have imagined would have been low. Well, I guess maybe not. People aren't moving around with COVID going on.
Well, and I'll tell you, Boise was really seasonal, very seasonal, really even still in 2019. There's a lot of companies out there that have no leases expiring in October through February on purpose because it was hard to get the rents that those people wanted. And we're seeing that shift because the demand is so much higher than the supply that seasonal is still a factor. But the importance of it is not as high as it used to be.
Got you.
May I ask a question? Melissa?
Sure.
What have you seen in evictions currently? How far back are the actual rents?
So I can speak from my perspective really solidly. I've only evicted 2 people in the course of the last 12 months, and it was for things very pre-COVID and issues that needed to go along. We have collected 99% of our rent the entire year. We have had, I can think of 5 people in the last year and a half now, or year and a couple months, that have needed help. And there's federal aid out there. Idaho Housing and Financing has more money than they can even give away right now because people just don't know about the resources out there. And so when they tell me they can't pay rent, I say, here's this resource, go, these guys will help you. In fact, I just had one the other day that was 2 months behind, and they paid those 2 months plus the next 3. So they're paid for through August. We're not seeing that here. NARPM nationally, which I know we're going national, which is not quite this market, but to give you a perspective, our organization is a national one, and we have done surveys all throughout the last year. And on average, they are still collecting 95% or higher across the nation. So people are still paying their rent. In general, there are cases, I don't know of any here of my fellow colleagues or myself that are 2, 3, 4 months behind. I do know some people in other states where it's very locked down, Washington, Oregon, back east, where very tenant friendly, that some people haven't paid for a year. But that eviction CDC moratorium is being tried. It's getting ready to be, it got overturned and they appealed it. So it's really a non-factor. In this market, it's a non-factor.
Excellent. Thank you.
Have you seen a lot of people taking advantage and following that lead to the resources that are available when you suggest it?
We do. And in fact, we just got ordered to put this special wording on our 3-day notices that says, hey, did you know there's all this available? So it's out there so they can take advantage of it. And we legally have to do that now. We're just very fortunate. People here across the valley have taken care of their responsibilities and they've paid their rent. I know we've had some issues that people haven't paid, and they've either gotten out or found a way. So it's just really it's
non-factor.
It's crazy for me to say this, but as an investor, it's just not something to be worried about right now.
Well, that's a good kind of crazy.
Yeah.
That we don't have to worry about that. Any final questions for Melissa before we move into some important information on tax assessments on the way and on the rise? Okay, featuring Kevin Sorensen. Kevin is the commercial and lead appraiser for Assessor for the appraiser for the Canyon County Assessor's Office. Kevin, I'm sorry, am I messing up your title? Tell me.
Not at all. You've made up it's a beautiful title. I like it a lot. Thank you.
Excellent. I think it won't be much of a surprise to anybody in terms of what we're seeing in the market, but give us the rundown in terms of what we can expect to see when our assessment notices hit the mail, please.
Okay, I appreciate being here. I don't have a picture deck like that last had, I'm just here to chat. This is all new to me.
Oh yeah, and I didn't even do a proper intro and say AVID Investors welcomes
Oh no,
Kevin
yes, I think
Sorensen from the Canyon County Assessor's Office. And we are going to find out, what do we need to know this year on these assessed values that are on the way. Now I'm going to stop sharing my screen because I think that we don't need the slides, and what you have to say is going to be the most valuable thing here. So.
Okay, thank you. Well, so as you all know, you've just tracked all that market data. We have tried to be conservative in the data that we use to assess the properties that are in Canyon County. I say that because you just showed a cap rate of 4. We use a cap rate of 5.25. So we used general expenses in about the 40% range. We just do an OER of 40. We even gave a 2 to, I think we used a 3 or 4% vacancy loss ratio. So when we're doing our PGI, EGI, NOI, we're pretty conservative, but the value still went up 30–40% from last year. I mean, it obviously it depends on the quality of the property, the age of the property, what it's competing against, but in general, there's a range from 20 to 40% on average. We saw so many properties sell. I mean, you just listed a property at 200 per door. I'm saying, so when I started tracking this stuff 4 years ago, it was a nice fourplex would sell at maybe 100,000 a door, and now we're saying 200,000 a door. When you're looking at brand new listings, they're building into their list price. Obviously, most of these are not even built, they're coming online, and so they've priced them for the knowing that they're going to appreciate in value. And I'm not telling you anything you don't already know. I'm just astounded because I can't. So from the affordability aspect, are the people living in these properties and they're still paying 20% more in rent? I'm just shaking my head. I'm saying, who are you finding to rent these properties? I mean, we've got Idaho's got a problem with or a complaint about low wages. And so if you use national, if our average rent is commensurate with Salt Lake, it's I can't imagine the stress on these tenants moving into these properties. It's a tough time. So anyway, our
I want to thank you
approach
for
to
something
valuing.
I'm so sorry. Before we get too far from it, I want to thank
Yeah.
you for something that you said earlier. You talked about the expense ratio that you're plugging in and the vacancy ratio that you're using. And everybody runs their numbers different, investors do, depending on what they're shopping for. But our pro forma tracks that data. We track expense ratios and we plug in a number for vacancy. And even though our vacancy is below 1% right now, folks, when we're running pro formas out there, I never put 1% in a pro forma because it just doesn't seem like a sustainable number to run a vacancy on. And we do look at those expense ratios, and that's in our template. So if you've got an analysis going on, it's really cool to hear, Kevin, the numbers you're plugging in. So thank you for that. In your cap rate, is that adjusted for taxes? Like, are taxes a part of your cap rate just like they are for ours, or do you somehow?
Yeah, no, we don't. So it's a loaded cap, I guess is the way they say that. The taxes are included in expenses.
Oh,
So,
that's why your expense ratio is so generous, because
yeah,
maybe ours
because
would only
that,
be 30%, but ours would include taxes.
no, ours does include taxes.
Mhm.
Ours does include taxes in the
Right.
expense ratio.
Okay,
And
okay.
then we still use a cap rate of, so. And this is a little, I know there's some people who want,
Okay, so what you're
they
saying
want,
is you don't figure a number in that's like taxes, so you're not using your data to create your cap. Instead, you just use the expense ratio to back into your cap rate.
yes,
Got it.
because not being a public a disclosure state, we don't really know how the expense ratio is for every property.
Unless
Every
people
property
share
that
it.
sells on the MLS, we can get the GIM, we can do an average income and we can divide that into the sales price and we can get the GIM or the GRM, and that's pretty accurate. But the times that we actually get cap rates, they all show us that 4.5 to 5 is what could be used in our model, our income model, but we have chosen to use 5.25 this year. And we probably aren't using as much income as the current market is allowing. So even though what you're going to see on your assessment notice is going to be a shocker, and it's the magnitude of the change from year over year, it's not what the market literally has done. But again, we're up till 12 months to January 1st of 2021. That's our lien date. So these last 5 months aren't counting. We're taking the data from 12 months backwards, using the last 3 to 4 months because they were most current. But so I think, yeah, that's the biggest thing for people to realize, is that we appraised. So when they call us and say that, man, that's a 40 or 30 or 40% change, we're saying, well, is it reasonable? Is it a fair market value? If you were a non-interested buyer, would you pay that for that property? And generally, that's the questions we always review with the property owner when they call questioning the assessment notice.
Mhm. And you're going for accuracy with your assessment notices. The goal is accurate. Do you have a mandate that you're within a certain percentage? I think it is plus or minus 10%.
We're right. So the legislator says 100% of market. And then our ratio, because they run ratios saying the difference between our sales price and our assessed price, right? If you've got our assessment at 500,000 and the actual sales price is 550 or 600, we're out of compliance. We've got a 10% margin of error, either higher or lower than the actual sales price of the data used. The state runs assessments or ratios. When they run their ratios, they actually use the data up till, I think, April. So they run their ratios from April to April. We run our ratios from December or January to December. So there's a little bit of difference in the data, especially in a market that's ascending as fast as this one.
Well, that's a good point. A data difference is a good point, because we've covered, okay, you've got a strong, solid model for running data. You've got a goal of 100% accuracy with a little leeway coming at you from the state. But you've also got a limited amount of resources and a lot of people and a lot of homes to assess if you're 2 to 100 and the residential appraiser is the same. And so what if someone not only believes, but then checks up on it and says, gosh, I really think I'm on the other side of the curve and my assessed value has come back high.
I am so glad to see their data. Absolutely. Because we are mass appraising. So we run a model that shows average this. So average expenses, average income, average cap rate, average property, right? So it's going to be it's going to be stratified by age. Of course, we're stratifying by property size. If it's a 4-plex or a 2-plex, if it's large properties, we'll stratifying the data somewhat there, but it can still be missed. I mean, we don't see every property every year. I try to see them once every 3 or 4 years to see if they've been changed. But most of them aren't degrading. They aren't declining in precipitously. They're mostly being uplifted. You guys are going in, taking a low quality property, investing some sweat equity or some actual money and making them nice. So what I miss on generally is that I don't have them to the proper condition. But that's not what you're going to find. If you've got a problem with the assessed value, I just need to see the data. I have no interest in appraising something at the wrong value.
Mhm.
I don't get a bonus. Sorry. If I got a bonus for the value that I come in at, that'd be great. But no, we're just fair market value is all we're looking for.
And do you tend to recommend an informal appeals process where someone calls the number on their assessment notice? Or do you recommend a formal appeal? What's the best way to start?
You are a good interviewer. Thank you.
Thank you.
Yeah, please just call me. My name's going to be on there. I think Ada County has an automated appeal where you can just go online and type in your information. It becomes an appeal. Canyon County does not have that. You have to call literally with your voice and say, hey, I have this issue and I want an appeal. And the first thing you're going to want to do is talk to me anyway. So my name should show up on all of the multifamily property assessment notices. Just call, chat. Again, don't get freaked out by the size of the change, but is it fair market value?
And that's
It's
something
not
we
fair
hear
market value.
emphasized in both counties. The change from last year to this year, it could be ridiculous, but that's not grounds for an appeal. What's grounds for appeal is what was the true market value of the property on January 1st or December 31st, 2020, or January
Thank you.
1st, 2021, right?
Yep. Our lien date is 1/1/21.
1/1/21. And then if somebody had a comp to include that was in February or May, what are you using? Are you having an average number that you would adjust for time?
Oh, again, very conservatively, as you ran your numbers, well, I think we're at 15% a year, 1.5% a month or something like that. What was that number? It's 1.25 or 1.5 a month. So whatever that number is, I forget. But so it'd be about 18%. Anyway, yeah, so it's not a massive number, not like the market really is doing. So we do the income approach, and we also compare to properties that have sold, and so we do what they call a market approach or sales price per
comparison.
door. Mhm. So we use both those models, and then we also will use a cost approach, but generally, as you know, your cost approach right now is way high compared to the old stuff. So you have to figure, if you've got an existing property and you're trying to rebuild it, so you got your brand new cost, you have to find a depreciation rate that somehow you can figure that out. We don't like the fair market value. We'll just use the income approach and what other investors are already paying for these types of properties based on the sales price per door. Our cash down to 5. I gave data to Greg, who is the chief appraiser, and I said, well, data is clear down to here. And he says, I think we'll just go to, we were at 5.5 last year. We just dropped it a quarter point. And I think we're comfortable with that.
That's
We
a,
were sort
yeah.
of we were sort of concerned about what the COVID, how it was going to play out with the market. We never saw a slowdown in the investor market or housing market at all. And so even though we were cautious about that, even last year in 2020, for what we didn't appraise to last year in 2020. But again, I appreciate not the size of the change, but is it fair market value?
Got it. That makes sense. And it makes sense not to punish landlords who are falling behind in their rent, because if those lease ups didn't happen just yesterday, then,
Yeah.
you know, that could be a factor. So I'd like to see if anyone has any burning questions at this time, because I know we're all getting our assessment notices. Actually, when do they hit the mail, Kevin?
The 4th, so Monday after Memorial Day, I think, or last Friday. I think we sent them out the last Friday of May. We don't have to have them out till like the first week of June, but we do send them out the last Friday.
And
That's
then
the goal.
what's the appeal deadline? I know we like people to come and ask early, but
The fourth Monday in June, your appeal has to be in paper. You have to have it returned to us. So if you wait till the 4th Monday and contact us, we won't be able to get you the piece of paper and hearing. So you have appeal process, which includes the informal, where you just talk to us, and then we send you an actual appeal and you send back your reasons, meaning where's your proof that we're wrong. And then we have the scheduling. Well, then we review your appeal, your information, and if we can't resolve it, then we schedule an appointment before the board of the county commissioners, who are acting as the board of equalization. And so they like to start doing that about 2 or 3 weeks after the mailing of the stuff. They'll be hearing other stuff, but as far as commercial, that's generally when we start hearing the commercials about 2 or 3. That's because lots of times it Monday in June is when we have to have the piece of paper back to us.
okay. And I had a bandwidth issue. I'm sure that transferred to everyone, but what we got was the appeals process. To kind of recap here, was you'll call Kevin, explain that you're needing to appeal, have a conversation, then you'll get a letter from Canyon County that says, please give us this formally, give us your comps, give us your justification. And that letter needs to be back to Canyon County Assessor's Office by the 4th Monday in June. Is that correct?
In order, yes, if we can't resolve it by the phone call and you're just sending us information without the formal appeal. If we have to have a formal appeal, then we'll send you an application. You'll return that application with your data, and then you'll get scheduled to have a hearing in front of the commissioners.
Great clarification. And so it's quite possible that if we've got some good comps, we email them to you, you have a conversation, and if that's resolvable or in any way, shape, or form, then that's a done deal. But otherwise,
absolutely.
Perfect. Okay.
Absolutely.
But if it's going further, the 4th Monday in June is June 28th. So you'll be busy.
Don't wait till then. Yeah, just call us. Just call me. We're good.
Well, that's great to know. And I think it's kind of speaks to Idaho as well, that we are still just a phone call away. And in Ada County, they say the same thing. They say start with an informal appeal and take it from there. And it's nice to be able to do that.
Mm-hmm.
Questions? Anyone? And then for your residential appraisers, you'll have, it won't necessarily be your name on their letter if it comes with a 1 unit.
That's right.
Perfect.
There's a whole team of people over there that will answer the same question. And they have the ability to actually run, the software has the ability to run a comparable check. So they can quickly, so again, they're not doing individual appraisals when they do assessment. So when you call and you have an individual property question, then they can at that point actually run a comparable sales check, and it will be a specific, your property's characteristics versus here are these 4 or 5 comparables that we've screened and time adjusted, and we can see if we're really out of whack.
And correct me on this, Kevin, but springing off what you just said, I hear the word automated valuation model, or, well, that's what I think, but I'm speaking jargon there.
Absolutely.
And so what this is, AVID investors, this is probably the same type of model that a Zillow would use, or somebody to predict your value with their estimates. And so you've seen how sometimes those are correct. And there's good data formulas behind them, but you've probably also heard someone say, particularly when it comes to Zillow, because it's easy to pick on them, that those datas are across the board and don't always hit the mark. And it's, you know, by no means do we tell people that they should tell us what they want what they should sell their house for based on a Zillow estimate. And so it's some properties just don't fit the mold. And a lot of times those are pretty heavily weighted on price per square foot and neighborhood. And so when you get neighborhoods where they're not very similar builds and homes, the further you get from like the quote unquote cookie cutter neighborhood, the further a price per square model might fit. What if that is true and false, Kevin?
Well, so we use ProVal, which is the software that is the name of the software we use. And in reality, ProVal is simply a database allowing us to track the properties, so their parcel identifying number, ownership, and then basic characteristics of the property. And again, the software itself does not generate the value. The software produces the piece of paper that we mail to you about its value. So we are modifying various parts of the assessment model. So we're going to take a look at all of the 1-story properties and then stratify them by age and size and even location at times, neighborhoods, who was the builder many times can influence the resale value or the fair market value of a property. And so the appraisers are looking at their neighborhoods and using ProVal to track all these data points about the property. They're going to determine if there's a view that this property needs to be especially adjusted for, or if there's a whole raft of problems in a certain neighborhood, the desirability of neighborhoods needs to be reflected in the values that we're generating. Are 2 stories selling differently than 1 stories? Are all of those factors are being tracked by our software, and then the appraisers are doing their studies, basically ratio studies on the sales data that we have, to find the factors that influence the values, again, on average, so you're going to fit the majority of the data into these averages. And so there can be times when your particular property has a feature that isn't well represented by the data and has to be specially appraised or recognized. So yeah, so that's the only difference I want to make. We are not Zillow, because we are really looking at the properties regularly. Zillow simply uses the assessor's data, or a real estate, let's see, they can buy data from First American Title, they run their own automated valuation models. They can buy data from Fannie Mae and Freddie Mac. So when there's been a transaction, they have all those appraisals that they've been putting into their computers, and that's how they find their data. The county assessors don't do that. They are a primary source of information about every property, every parcel that's in the valley, in the county. So anyway, that's the difference between an AVM and our computer-assisted mass appraising software, or CAMA.
Got it.
CAMA. Okay.
Got it. Thank you. All right. Now, if there's not any questions at this juncture, I might give a little recap on what we heard from the Ada County side of things. But folks, go ahead and jump in and interrupt if there is a question, because we still have Kevin here. But the 5+ units, Craig Church explained, the commercial assessor appraiser explained that they are reappraising the 5+ units in Ada County. So they kind of, I'm not going to say it as well as he did, but they kind of run it each year without looking at the individual properties, but then they go through a full-on reappraisal of those actual properties. So that's happening. So your property has been given a good, closer look this year than it did in previous years. And overall, the median increase that we're seeing, it was in Ada was around 27%, but up to 45% in Ada County. And in residential, 25% is a common number to 28% as a median in terms of the increased assessed values. So one said it's going to be a bloodbath out there this year, just because people will accidentally focus on the change in value. But to Kevin's earlier point, if they've been watching the news, they probably know. They're looking at about a 1% spread between current current rents and what pro forma or market rents might be. And that's something that I'm seeing, roughly speaking, that sounds like something we're seeing on a lot of our pro formas, where I've actually started running pro formas looking at what's the current rent doing and what is the market rent for that property. And if appealing a commercial property, they're going to be looking at, with 5+ units in Ada, they're going to be looking at all the numbers and more than the sales comparison approach. So they're going to want to ask for a 3-year trailing P&L, a 1-year, a January 1st rent roll, and a few things like that. And in terms of values in Ada that we've been seeing, what they've noticed is between January and September last year, they were seeing about a 1.5% jump. So any comps for the residential side, pausing, when we do residential side, we look at sales comparisons as opposed to just the numbers. And we have to time adjust those comps to that January 1st date, just like Kevin said, we have to do in Canyon County. So January to September, they're looking at around a 1.5% time adjustment. 2.5% is their number October to December. And then things that have been going in Q1 of 2021 is even higher than that. So that's really a testament to what our market has been doing, what our prices have been doing, what our assessed values are about to do when they hit our mailboxes at the end of May. And then subsequently, that of course is a huge part of the tax formula. So we'll see how the levy rate's affected. And a reminder to go to your budget hearings if you really want to weigh in on how much that hits you personally, because those budget hearings are public and those are what are going to define the levy rate. Those budget hearings define the overall amount of pool that's needed. And then all those individual assessments have to fill that pool, and then that money goes to do all the things. And so it's the levy rate times your assessed value that's going to be your taxes, and that levy rate really is affected by those budget hearings.
Can I ask a question?
Please.
What about your, or have you heard or discussed being a good Samaritan and not raising your rents a whole bunch. And so how come I don't get a tax break? Does anybody in your group ever had that conversation?
Well, that's a great, it sounds like a great argument in an appeal, and maybe you're going to tell us why it will or won't work. And I'm so interested in hearing.
Yeah, it won't work because we appraise average market rent. So the person who has this desire to not raise the rent on their long-term tenants because they've been there forever, they lose every time because the legislation, the definition of market value is fair market rent. What is so I always tell the people with that concern or that desire to have rents affordable for their poor people that don't have Section 8 housing or anything, I always say, well, you ought to sponsor a bill and have a Good Samaritan credit of some sort created so that if you prove that your rents are below market and you're doing it for this reason, maybe the state, the tax, or the county could then really offer a discount. Right now, there's no leeway for doing that. We thank them.
In ADA, if they're asking for the rent roll, that might help a little bit in terms of if they're looking at your trailing profit and loss and a rent roll, it could potentially induce an appeal there. Do you know?
I'm not exactly sure what they're trying to do with that. Ada County appraises differently than we do.
Right, which is why I'd like to talk to both you. So thank you.
Yeah,
and I do have
they
a
have a
video I
different
can play of.
source.
Yeah.
I'm sorry. Ada County, because they have such a much larger pool of properties that they have to appraise. I think they have a different mindset and I don't know that they've got as much manpower, woman power. They don't have as many appraisers in their office to handle that amount of data that they've got. So I think at times they're shall I say, they're taking it easier on the assessed values. They're not really coming to full market value. They haven't got enough people in their office to fight it or to actually appraise it all, I don't think. I mean, even...
Yeah, I'm going to share, since we're moving into ADA, this just seems to be the perfect time to segue. So I'm going to try to remember how to share my screen again. Holding on, let me see if I can. Okay, hold on, here it is. Safari. I'm going to try this. This is a little experimental. Here we have on the left, Craig Church and Dan Curtis, because that's your goal, is to be right on. And sometimes we've benefited from values a little bit lower, but for the most part, last year you were pretty stinking close to full values, and that's the goal.
Yeah, I think you're sharing the wrong thing. Roughly 96% or 94% of market value, which we're going to have to try and recover on the residential side this year, as well as any appreciation or market growth that occurred during the 2020 market year.
And market growth, you're talking about time adjusting comps based on, when you're appealing or when you're looking at a value, that's the January 1st value. So there's a lot of time adjusting there. And I thought it was really interesting what you were saying is what general numbers you were using for time adjusting.
Yeah, from January through September, we're estimating that to be roughly between 1.5% to 1.7% per month. Moving into October, November, and December, in the fourth quarter of 2020, that could be closer to 2.5% a month to get us to a full market value on January 1st of 2021.
And then Q1 of this year?
the analysis is still out there, but very well could be close to 3% per month.
Yeah, so that spike is real. What we're hearing about in the news is real, and it's that reality is not going to just fade away when it comes time for our assessed values. We might get to see it firsthand, all the equity, hopefully, that we have.
Well, and if there's any safety net there, is that while market values can appreciate or decline 20, 30, 40% relative to what the market conditions are, the budgets are capped at a 3% plus new growth on an annual basis. Maybe better explain that would be last year's budget plus new growth, and adding 3% to that would be the maximum that those budgets can grow in any one calendar year.
Right. So even as we're being taxed, or being exposed to all this growth, those budgets they're not endless in how much they can go up, so they can't suck up too much money, even if the area is growing.
Correct.
I did not say that any better than you just did. Much worse, actually. But that brings us to the main point, or a real good point, is if we're upset by what we see, the number one way an property owner can get involved in this process is going to the budget. That's something that we can weigh in on, is those budget hearings.
Yeah, and we encourage people to actually go to those and voice their concerns over what's happening with the budget. And if you're concerned with the assessed value of your property, in the upper right-hand corner of your assessment notice, you'll have the appraiser's name, their email address, and phone number. So if you think your property is assessed too high, definitely contact your appraiser as soon as possible and discuss the value with them.
And it's pretty great that locally speaking, there's that step one. We don't have to go straight to the formal process in writing, but we can reach out to that person on that appraised document, that notice document, and it's usually recommended to do so, to do an informal appeal, where informal still means having data and points to present, but you get to present them directly to your assessor.
Yeah.
Okay. Let's see. That kind of cued into some of the things that we've been talking about, but questions. Does anyone have questions?
I would love if you called me when your property value is too low too. Just laughing.
That could be a tough sell.
You're getting right to the person that's.
Oops, sorry. Do you guys still see my screen? I'm not as adept at this sharing stuff. How do I stop share? There we go.
There.
Thank you. All right. Well, I think that pretty much sums up the major points when it comes to these tax assessed values. So, last call for questions out there. Cynthia?
I do have a question, and that's if there's not very many comps to do an appeal, if one was needed, what do they use? Do they use just whatever has sold relatively two plus units? So I've noticed over the last year, I've been looking at comps for, my multifamily, and there hasn't really been too many. So I'm just wondering if, how I get the comps, and especially when they're not very many pending or sales.
So in Canyon County, if you're talking about duplexes, there's
Ada County.
Ada. I don't know how many sold in Ada County. Sorry.
How many sold in Canyon?
We have like 60 that have sold a lot more if there'd been more to sell, you know that as a joke. We had about 60, I think, of various ages, so they get stratified. But we have a breakdown that showed they sold the older ones at about 120 $25 a door up to $250 to $300 a door for duplex, brand new duplex. It shocked me, but they're living in them because instead of being an investor, they're buying them as though they're their owner occupied property because there's nothing else available.
And we see that a
So-
lot when with duplexes, they don't follow the same fourplex trends. And so maybe Cynthia, on your question, if there is a shortage of comps for you for your duplex, they might look further away in different areas. There certainly is our duplexes in Ada County that you could try to use similarly.
Okay, so I guess misunderstanding is I have an X, and so I've been following eightplexes, like, you know, anything close to an eightplex. But when I was listening, I heard, you know, they're looking at 2+, you know, 2 and above, you know, so you probably thought I meant duplex, but I meant
Oh.
eightplex. Not too many duplexes have been on the market and sold this last
No.
year.
I just
Well,
listed
they're
one
just-
in North Boise and it sold for 1.25. Also in North Boise, one sold for 1.4 a little while ago. That'll be an older property, comparatively speaking, but they will use the income approach on eightplexes, and that'll be Craig Church's department in Ada County. And so he'll use a similar formula that Kevin discussed, but with whatever their numbers are in Ada. And so Craig, to appeal, would look at the numbers. So you would run a pro forma on that property and see if you're hitting around a, what did they say they were doing on cap rates in Ada? I think they might be around a 5% cap rate in Ada as well.
Mhm.
And if that's what you're being assessed at, you might be able to share, if you're willing to share all your financials with Craig, he'll take a look at them. He'll look at your January 1st rent roll. He'll ask for 3 years trailing on your P&Ls, and he'll let you know if you have any room to appeal based on that.
Right. I just think there's kind of a conflict because of the year being COVID and, you know, rent being a problem for people. I didn't keep up with the growing, and I'm sure a lot of others didn't want to raise it due to COVID, but now we're getting hit by higher taxes. So we're going to have to, you know, raise the rent to.
Well, that's where in Ada, it's a little bit different than what Kevin's approach is, because they're total different processes, but doing the same thing. And in Ada, they will look at your January 1st rent roll. And so since that video wouldn't share right, I didn't want to let it play any longer. Apologies for that. But your rent roll potentially could make a difference. So
they actually are appraising on actual income and actual expenses. That's what your 3 years would show, is what your expenses are.
Right.
I would think that, well,
I can work
Okay,
with them. I just wondered, like, if I, you know, need to get comps, where I'm, you know, going to get them from, if there hasn't been too many for eightplex, and then the rest of the
5+ is a pro forma. So you don't need the comps for an eightplex. You just need the pro forma and your data.
Okay, good, because that's always been kind of
right. They're not going to be property specific when they're, because your investors aren't going to buy just eightplexes. They're going to buy on income. They're going to buy comparables. So don't get hung up on the property specific.
okay.
And in Ada, they do commercial means 4+ units. And in Canyon, as Kevin has shared, it's 2+. And so
Commercial. Oh, so it still is 4 and smaller are residential appraisals, are residential properties, and 5 and up are commercial. And we base that on just on what type of loans you can get. So to get a 5-plex, you're typically getting a commercial loan, and on a 4-plex, you can still get a Fannie Mae loan or FHA loan. So those are still residential.
yeah.
That's how we break that. Sorry.
Okay.
Yeah, and he said, I'm looking here at my notes from Craig and Dan, and he said cap rates in the 5s based on market rents. But you might be able to share your rent roll and see if that matters.
Mhm.
Any other questions out there?
I got a follow up to that. My name's Jerry. First time I've joined here, so I appreciate the info. And I probably missed this when you talked about it earlier. So when is the appraisal? What subset is based off rent roll and what is based off comps?
Are
Five
you talking to
plus.
Ada County or Canton?
Ada is 5 plus, and that's what we were just talking about, 5 units plus. Kevin, what's Canyon?
There's no break. I do comparable sales value per door and income on both sets. On duplexes, I do an income approach as well as on the so everything gets an income approach and a comparable sales approach.
Okay, and so you consider both in the end result number you come up with, or you weigh one over the other, or?
Right. So yeah, I probably the income approach is the one we can certify on, the way we look at it, but we can certify on the GIM income approach, or we can do it on the capitalized income, NOI. It just depends on how much data we have, but like data set, if we've got lots of duplexes, threeplexes, fourplexes, we'll probably just do the regular income and not go to the GIM. But then again, it's weighted against, well, what are they actually buying fourplexes for? How much dollars per door? So then we look at the two and we say, yeah, the income approach represents close enough to what actual market is when we see all these fourplexes that are selling at 150 to 200, to $175, $175,000 a door. So we'll just compare the two and see if they're out of line or if they support each other.
Okay. All right, and then Stacy, you said in Ada, 4 and below is comp based.
Yes, sales.
And 5 plus, so similar to the commercial delineation.
Yes,
Doing a commercial property in that.
that's correct. And by the way, thanks for checking us out and joining today, Jerry.
Happy to do it. I always end up with a conflict this time. I've been wanting to join for some time. So fortunately able to get at least part of it in today.
Yeah. And did you get your question answered?
I did. Thank you.
Cool. Any other questions out there? Because we'll probably start to wrap it up. If not, we try to keep them short on and punchy with the Zoom, and but we should be getting back to this in-person format soon. I just need a month to gear back up for that and get it back into my schedule where I'm used to heading to the store and filling up a cooler and doing all that fun stuff for everyone. So Jerry, be sure you come again in person when we meet if you don't have a schedule conflict. And then also, maybe we'll be able to keep things zooming as well so that people can track real time. I haven't figured it out if we should do that or not. And I'm not good enough at using Zoom to do a poll right now and ask that question. But for those who can come in and Zoom in from home and can't make the meeting, maybe that's something we could try to continue. It's an idea. Melissa, Sharone, thank you so much for
thank you.
Great rental market update. That information is helpful to every single one of us here, and you're such a resource, you and the team at First Rate Property Management. Thank you.
Thanks, Stacy.
And Kevin, it is so great to finally meet you from the Canyon County Assessor's Office. We've met Brian Stender. He's spoken with us before, and I really value all the information that you shared. And most of the time it didn't go over my head, but I trust that for the information that was really detailed, if any of us have some follow-up questions or we get those assessment notices, it sounds like you make yourself available and by phone calls, and that's hugely valuable. So thank you.
Thank you. It's been a pleasure.
All right.
Yeah, thank you, Kevin. Hey, one quick question. So I see this is being recorded.
Yes.
And I missed the beginning. Is there a way I can get access to the recording?
Yes, it'll be on my YouTube channel, but I can't promise when. But I can share the presentation with you, the presentation portion with the rental market update slides. So if that's any help, we can try for that as well.
Yeah, definitely interested in
Appreciate
that.
that.
So.
All right, and my I think my YouTube is in flow, and or you can email me for that. But thank you, avid investors. Have a great night.
Thank you.
Thank you.
Good night.
Bye.
Thanks, Stacy. Ciao.
Yeah.